everyone, welcome back. I'm Amber at Biweekly. Today, let's jump right into China's recent tech stock rally. We've seen a huge rally in Chinese tech stocks, and it's all that people have been talking about recently. Some Chinese netizens are even joking that instead of making America great again, Trump is making Chinese equity market great again. The US and China haven't decoupled, but the recent US and China equity markets certainly did. So will this rally last, or are we just seeing another brief moment of euphoria? So let's talk about that today. China's tech sector has been having an incredible run in 2025. Hang Seng Tech Index has gained over 33% year to date, just one quarter into 2025, and over 64% in just under 1 year. But the interesting thing is, nothing in China has materially changed in the past 3 months. The macroeconomic landscape is pretty much the same. Consumers are not behaving that differently, and tech companies like Tencent or Alibaba haven't exactly begun to monetize their AI initiatives. The only thing that's changed is that Deepseek made a bunch of people realize that China is back in the global AI race. Suddenly, everyone is talking about that, like how Tencent and Alibaba are boosting capex to invest more in AI. And a lot of the rally so far is because of that repricing, but nothing has changed materially. So for that reason, I think it's a good time now to consider whether the bull run will sustain. There are a couple of factors that may indicate some short-term vulnerability for Chinese equities, especially Hong Kong stocks. First, the MSCI China Index PE ratio is peaking at around 12 times, which is within its 10-year historical average range. You could argue that Chinese equities are fairly valued right now, or at least I think there is not as much upside as there was last year. Second, the risk premium between China and US equity have narrowed significantly. While China is still attractive and trading at a discount relative to the US equity, the gap is smaller than it was just a few months ago after the recent sell-off. Third, as global investors diverge from US equities, foreign equities are flowing more into European and Japanese market than into China at this moment. This could provide less support, especially for the Hong Kong market. So I'm personally still bullish on China, but I'm not chasing new highs at this moment. I think there's a lot of long-term potential here, but I would give it more thought in the short term, unless we see something that changed the game, like real practical application of AI, or more companies making a lot of sustainable revenue from AI, or like a really significant recovery in domestic consumption and real estate market. Before that, I would like to stay sober and not get overly excited. So while the tech sector might be a bit overheated right now, other sectors are quietly starting to show some strong potential. For instance, I think it's a good time to look at consumer sectors in particular. Now, Chinese government has been pushing policy after policy to boost consumption, and you can feel that in the air. For instance, take a look at the recent moves in places like Wuhan, where local governments are offering milk coupons and cash rewards to families who have children. It's getting a lot of positive reaction from the market, and this is a huge move because in the past, most of China's stimulus has been on the supply side, or indirect ones like coupons or vouchers. But now they're focusing on demand side, especially addressing countries' pressing low birth rate issue. If this kind of policy spreads across the country, we could see a real boost in consumer confidence. And I made a video back in December last year to walk through this policy priority shift in detail. So if you're interested, you can go back and check out that video. So in fact, if you look at the numbers, we're already seeing some early signs of recovery. For instance, in the past month, the food and beverage sector has outperformed tech stocks by a pretty significant margin. And when you look at sectors like metals or high dividend stocks, they've been doing better than the tech sector as well. And I think this is definitely an early sign that investor sentiment is shifting away from just tech and spreading into broader areas of China equity. So today, let's talk about consumer sector opportunities in particular. Before we jump in, I want to give you a quick side note. I do these market updates bi-weekly and sometimes more often if the news flow is strong. This channel is all about providing actionable data and insights on China. So if you enjoy the content, please make sure to subscribe and stay tuned. For those looking for even more in-depth analysis, we run a newsletter service to share exclusive equity research and insights through our private Discord channel for our paid newsletter subscribers. So if you're interested in that, the link is in the description box below, so check that out. So back to the consumer stocks opportunity. But let's not get ahead of ourselves. Consumption in China has improved, but only moderately. In January and February this year, retail sales grew 4% year on year, which was in line with the market expectations. but it is a moderate growth, and it's too early to say that the trend will continue simply based on 2 months of data. The consumer confidence index has only ticked up slightly, and we're not seeing a massive shift just yet. So be selective, that's my advice. You don't want to throw your money into just any consumer stock, but there are definitely a few that stand out. First, I like digital electronics. The sector is doing pretty well, especially with the government's trading programs and state subsidies that's going to last into 2025. But I'm not too crazy about the home appliance company, even though they also get the trading subsidy. Home appliance is among the first major category that start the subsidy program, and the program have been running for a while. And you can see that online sales are slowing down visibly. The reason for that is these are big ticket non-recurring items, and the same thing might happen to digital electronics in the future as well. And let's see how long the purchase will last after the subsidy program runs for a longer time. But I think for now, at least this year, sales are expected to grow strongly for digital electronics. Second, I like dairy. This is sort of like a niche area, but the reason that I mention is because the recent birth subsidies are causing a rally in dairy companies like Mengniu or Yili. The expectations here are huge. If the policy expands, there will be likely a lot of milk consumed in China going forward. And that's partially why stocks like Mengniu have been up 28% in the last month alone. But remember, it'll take time to see how this actually plays out on the ground. It takes time to make babies, right? But the reason I think you should keep this name under your radar now is because looking at the sales from a panel of the convenience stores and supermarkets that we track, dairy companies have been doing better in sales since 2024. So it's not just market sentiments. The sales numbers are giving solid support in addition to the policy stimulus. And lastly, skincare and sportswear are sectors I'm keeping an eye on. Both categories have seen solid year-on-year growth in online sales, even without any direct government subsidies. The average selling prices are also increasing, and this means that some consumers are still willing to spend on those items. China's beauty market witnessed a slowdown in mass market demand over the past few years, but the high-end segments remain resilient. And there's a clear trend emerged that consumers are favoring domestic brands like Giant Biojin or the newly IPO debut Mao Geping. The latter is seen as a rare domestic brand that's targeting high-end consumers. Similarly, sportswear kept recovering in Jan and Feb this year, and premium brands like Lululemon did pretty well. Professional running shoes maker On and Hoka outperformed their peers as well because of the rising interest in running in China. For example, I've written about how marathon is becoming a new rich people sport in China. So if you're interested, you can check that out in the description box below. So there you have it. While China's tech rally may have been exciting, I think now it's a great time to shift the focus and look at other sectors like consumer goods. They're showing real growth and the policy support is definitely there. Before I wrap up, just to remind you again that if you enjoy these market insights, I do these updates bi-weekly. So don't forget to subscribe for regular updates. And if you want even deeper insights, please check out our newsletter, and the link again is in the description box below. All right, so what do you think? Will China's tech rally continue, or do you see bigger opportunities elsewhere? Let me know in the comments below, and I will see you soon next time. Have a good one.